Hello, my name is Taylor Walker and I will be discussing sensitivity analysis in the capital budgeting process. Essentially, sensitivity analysis is the process of determining the answer to different what-if scenarios that surround a subject as it pertains to its viability. Sensitivity analysis is utilized in a multitude of disciplines, but it has a critical function in business. Typically, sensitivity analysis focuses on the black box process in order to see the cascading effects that occur from changing an input variable on different pieces of the resulting data. Not only does this help to determine the financial viability of an investment, but it can also identify the critical and non-critical variables in the risk calculation of a specific project. Thus, identification of the crucialness of the different variables help to identify and mitigate risk. This can help analysts more accurately forecast the probable profitability of a venture. Therefore, sensitivity analysis is a valuable tool to ensure a firm's continued growth and profitability. Capital budgeting is the process of allocating funds to projects that will increase the firm's worth. In other words, it is deciding the projects that a firm should invest money into with the expectation of making a profit. This becomes especially important when considering that projects, such as bringing a new product to the market or investing in assets to reduce production costs, are multi-year endeavors that may not be immediately profitable. Therefore, a company must discern which projects to fund and which to discard. Sensitivity analysis is a tool that assists businesses in making those decisions. Budgeting decisions rely on calculations that are obtained from forecasted inputs. Therefore, these calculations are susceptible to error. This is where sensitivity analysis plays a role in the capital budgeting process. Sensitivity analysis allows analysts to determine an investment's potential profitability even with changes in predicted cash flows and fluctuations in the markets. There are multiple calculations utilized in the capital budgeting process. The three primary calculations include net present value (NPV), internal rate of return (IRR), and modified internal rate of return (MIRR). Each of these calculations rely on a projection of cash flows along with an estimation of the work average cost of capital (WACC) over the lifespan of the project. There are several factors that can affect cash flows in the WACC over the course of a project. For example, cash flows may not meet expectation either due to a lack of demand or increased competition in the market segment. Likewise, the financial markets are susceptible to changes which may increase the WACC. Predicting these occurrences can be difficult, but sensitivity analysis affords an opportunity to test a product's susceptibility to these factors and therefore allows planners to determine if the risk of a project is worth the potential return. When considering NPV, IRR, and MIRR, it is important to understand what each calculation measures and the potential variables that can be altered. It should be noted that a thorough capital budget should utilize all three formulas, and likewise, sensitivity analysis should be conducted for each calculation. When calculating the NPV of a project, the result is going to be a dollar figure, whereas IRR and MIRR will provide a percentage that documents the profitability of the investment. IRR and MIRR calculate the discount rate needed for the project to have an NPV of $0 based on its projected cash flows. IRR will calculate the discount rate with an assumption of equal reinvestment of the profits, whereas MIRR calculates the discount rate assuming the profits are reinvested at the WACC. Therefore, the only variable that can be modified in IRR would be the cash flow, whereas MIRR can be modified by cash flows and WACC. Like MIRR, NPV can be modified with different cash flows and WACC. Therefore, modifications to these variables can help project the potential risk of a project. Ultimately, sensitivity analysis is a tool utilized in the decision-making process. A firm is always going to seek to maximize profits while minimizing risk, and sensitivity analysis is utilized in identifying potential risk in capital budgeting. Certain projects are more susceptible to these risks than others, and this will be revealed in differences in the variables utilized to complete their calculations. When viewing a project on its predicted numbers and discount rate, a positive NPV and a discount rate that exceeds the WACC signify a profitable project. A project that shows great reductions in either of these numbers based upon small changes in the variables demonstrate the volatility of an investment and may require greater consideration before adoption. This allows decision makers to adequately weigh the cost of a project to its potential risk.